We're in very early days in terms of AI and its impact on the global economy. If you think in terms of internet time, we're in the early 90s, if not before. So just want to state that out. What they call it, the $600 billion question, I think it is. Who's going to make the money off of AI? Or is this going to be just completely commoditized, given how much capital is being thrown at this form of innovation? Well, we're getting some clues as to where we are in this earnings season. So we thought we'd share some thoughts around NVIDIA and some other companies that are giving us a sense of how this world is going to evolve. And it's very fluid, and as I said, very early days. But we think we're at the beginning of one of the most fantastic technology journeys in history.
Bitcoinzilla stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad, Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoinzilla today and enjoy the new edge. Cathie Wood discusses shifts in the AI market and where value can be captured. Cathie also breaks down surprising economic trends, from surging retail sales to a cooling housing market.
Interestingly, you see that M2's growth has moved from negative into positive territory, but is still very low by historical standards. That's the purple line. In the green line, you can see the CPI, which it's not a perfect correlation by any means, but you can see the message from this chart because the money supply growth rate has moved forward. The message is inflation is probably going to drop. Let's see, the CPI is on the left-hand scale here, into the 1% to 2% range. And we would not be surprised to see it go negative as we did in 2020. And we saw in 2014 and 15 and even before that in 08, 09. So we think that will happen again, and that the Fed is going to be easing aggressively before all is said and done. And on this next page, here I've presented the yield curve for many months now. And you can see the yield curve had been flattening and then inverted, and has been doing so really since 08, 09 in a trend sense. But you see what happens after an inversion and a move back above zero so that short rates are below long rates. What does that typically portend? It usually means we're in a recession. You can see the shaded lines are a recession. You can see we had gone inverted. It doesn't show here. You can barely see. We inverted for a few months in 2019, and we didn't know about COVID, and we'll never know if the inversion was an indicator that a recession was going to take place. But we did end up in a recession. Here in 08, 09, moved positive. We were moving into a recession. Here we were in the recession in the tech and telecom bust. We were in the recession during the S&L crisis. We were in the recession as Volcker was trying to starve the economy of money to squelch inflation. So we're probably in a recession, and we probably, by some metrics, we have been in a recession for some time. Rolling recession, I know I've been saying for a long time. Housing went down immediately and is actually in a depression. But we do think that's a rubber band stretching, and that's why we don't think that this recession is going to be that bad. It could actually end quite quickly if we get those interest rates down and get the cyclical sectors of the economy cranking again, with so many people waiting on the sidelines, especially for housing, new and existing homes.
Bitcoin fell 8% between September 4 and September 6, breaking below the $54,000 support for the first time in over a month. The correction accelerated after U.S. labor market data was released, though negative momentum had already been building due to ongoing outflows from spot Bitcoin exchange-traded funds, ETF. Traders are now considering whether additional factors contributed to this recent price weakness and how likely it is that Bitcoin will revisit sub-$50,000 levels. It's essential to assess how weaker than expected U.S. non-farm payroll data impacts the Federal Reserve's Fed strategy of lowering interest rates without causing a recession. Sonia Varghese, global macro strategist at Carson Group, told CNBC that payroll data indicate risks are rising as the labor market is clearly softening, and the Fed needs to step in to cut off tail risks. Despite this, there is no consensus on whether the September 6 labor data increases the probability of a broader stock market correction. However, the CME FedWatch tool suggests that the odds of a 0.5% rate cut in September have risen. The S&P 500 is on track for a 4% weekly drop, potentially marking its worst 5-day performance of 2024, mainly driven by tech sector losses. Emily Rowland, co-chief investment strategist at John Hancock Investment Management, commented, "The market's oscillating between this idea of is bad news, or is bad news, good news, and the sense that it may revive hopes that the Fed moves more aggressively than markets anticipate. In short, traders are concerned about recession risks but optimistic about a potential shift to a less restrictive monetary policy." Satch Pandal, head of research at Grayscale Investments, is more bullish. He noted, "The August jobs report hit the sweet spot for Bitcoin. The labor market has slowed, which will allow the Fed to cut rates, but there are no signs of recession." Pandal also mentioned that the U.S. presidential elections in November and large U.S. budget deficits create a favorable environment for Bitcoin's institutional adoption. In light of the short-term uncertainty in traditional markets, especially the tech sector and artificial intelligence investments, it's clear why investors have been reluctant to increase their Bitcoin positions, despite the recent price drop. Additionally, Warren Buffett's conglomerate, Berkshire Hathaway, reducing its stake in Bank of America, has only added to the bearish sentiment. The latest 7-day record of net outflows from U.S.-listed spot Bitcoin ETF has sparked questions among traders. They are now speculating whether the current price action reflects moves by savvy investors anticipating further volatility, increasing the possibility of turmoil in risk markets. Some suggest that fears of a tech bubble are driving the demand for short-term government bonds, while others point to stress in the commercial real estate sector.
But anyone who faces price deflation, and we think many companies will, is going to adopt new technologies that are going to increase their productivity dramatically. And that is what always happens during a recession. Innovation gains traction. Consumers and businesses are willing to change the way they do things when they're fearful. And we think they're getting fearful. So we think there's going to be a lot more technology adoption, especially around AI during the years ahead. So I'll end up where we started. We're in very, very early days with AI. We think it's the most important general purpose technology transformation in history, and that it has miles to go. And the rate of change is so much faster than it was during the internet age, which was all around Moore's Law, which was, in the transistor world, semiconductor world, same performance for half the cost every 18 to 24 months. Today, the changes are not happening in 18 to 24 months. The performance changes for the same cost, they are happening every 4 months. And that's why we think it's important for, anyone, whether you're an employee or a business leader, to think about embracing as many of these or harnessing as many of these AI tools to increase productivity as possible, because the competition is going to be very intense. Those who adopt these new technologies the fastest are going to win.
Regardless of what is causing traders to become more risk-averse, the yield on U.S. Treasury 2-year notes has dropped to its lowest level in 2 years. Investors are willing to accept lower returns in exchange for the safety of these bonds. Adding to the bearish tone is the recent negative ruling in Coinbase's attempt to dismiss a class action lawsuit brought by its shareholders. The plaintiffs allege that the exchange misled investors about the risk of regulatory action and potential asset losses. While the ruling may not directly impact Bitcoin's price, it reduces the incentive for institutional investors to enter the market. Bitcoin investors are also concerned that miners may be forced to sell some of their holdings. According to Glassnode data, miners have been accumulating Bitcoin since August 15, but as the price remains below $60,000, sell pressure from miners could build. In short, both macroeconomic factors and regulatory issues, combined with the fear of a miner sell-off, are contributing to the bearish sentiment surrounding Bitcoin. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.